This video reviews KDDI's financial results for the second quarter of fiscal year 2026, covering the period from April to September 2025. KDDI is one of Japan's leading telecommunications companies, competing with NTT and SoftBank Corp. Under its AW brand. KDDI also jointly operates Lawson convenience stores in partnership with Mitsubishi Corporation. In the first half, operating revenue rose to 2,963.2 billion yen, up 3.8% year-on-year, while operating income increased 0.7%. Net profit also grew to 307.7 billion yen, reflecting a 7.6% increase. Overall, KDDI achieved higher revenue and profit, with a net profit progress rate of 50.5% toward its full-year forecast, indicating that the company is on track to meet its fiscal 2026 earnings targets. KDDI's results improved in the second quarter partly because the effects of its phone price revisions started to appear. These adjustments led to higher revenue and stronger profitability. As a result, operating revenue, operating income, and profit for the period all increased compared with the previous quarter, showing steady quarter-on-quarter growth. In the first half, overall operating income increased from 573.1 billion yen to 577.2 billion yen, reflecting steady growth across multiple businesses, while offsetting the negative effects of the prior year's one-time promotional expenses. The mobile business, which is the core of the personal services segment, continued to drive overall performance, supported by structural reforms and steady growth. The DX and finance businesses also contributed positively, showing progress in line with the plan. Energy and Lawson maintained stable results as well. Although there was some negative impact from the previous year's promotional expenses, part of which was temporary, all major businesses continued to grow as expected. Overall, KDDI remains on track to achieve its full-year income targets, with further acceleration expected in the second half. KDDI expects its operating income to increase by about 55 billion yen in the second half, led mainly by strong performance in mobile, finance, DX, digital transformation, and other focus areas such as energy and Lawson. In the mobile business, KDDI plans to accelerate growth by enhancing service value through price and plan revisions, aiming for more than 30 billion yen in full-year gains. The finance business is shifting its focus toward improving the loan-to-deposit ratio, strengthening the foundation for sustainable profitability. The DX business services segment is expected to recover and expand, driven by a turnaround in BPO, business process outsourcing, and other initiatives. Additionally, the negative impact from the previous year's promotional expenses has already ended in the first half, allowing a cleaner comparison and stronger momentum in the second half. Overall, KDDI projects that mobile and other focus areas will be the main engines of profit growth, helping the company achieve its full-year earnings targets. During the first half, mobile ARPU, average revenue per user, increased steadily, rising by 140 yen year-on-year. This growth reflects successful service revisions and value-added offerings that encourage customers to stay longer and spend more. At the same time, the smartphone churn rate, or the percentage of users leaving KDDI, continued to improve quarter-over-quarter, narrowing the gap from the previous year. In the second quarter, the churn rate decreased by 0.12 points year-on-year, indicating stronger customer retention driven by longer contract durations and enhanced service quality. Mobile revenue has been increasing year-over-year. This growth is supported by a reduction in churn rate and higher ARPU driven by structural transformation, further improvement in brand mix, and increased contribution from service revisions. KDDI expects that the impact from service revisions will be even greater than initially forecast. Mobile revenue growth is strengthening, especially in the first half of FY2026, and KDDI anticipates continued momentum in the second half due to strategic service and brand improvements. In the second half, operating income is expected to rise by about 55 billion yen, driven mainly by four areas: mobile, DX, digital transformation, finance, and other businesses such as energy and Lawson. KDDI plans to promote growth initiatives in finance and DX, which are recognized as key drivers for future earnings. Although these businesses faced some challenges earlier in the year due to changes in the business environment, KDDI is addressing them with targeted strategies to regain momentum. Meanwhile, Energy and Lawson continue to perform smoothly, contributing stable earnings. In the mobile segment, growth will accelerate as service improvements and structural reforms show stronger effects. KDDI's finance business focuses on building a stronger and more sustainable growth foundation through its banking and credit card operations. KDDI is shifting its strategy to emphasize the loan-to-deposit ratio, responding to changes in the deposit procurement environment. This means KDDI aims to make more efficient use of deposits by expanding lending operations and balancing its financial structure. In the banking business, KDDI is working to enhance deposit collection capabilities and increase the number of active accounts, supported by partnerships between its banking and securities units. As of September 2025, personal deposit balances were up 1.3 times year-on-year, reflecting strong growth. In the credit card business, membership is also expanding steadily, especially for the APay Gold Card, whose member base exceeded 1.7 million. This growth is being driven by bundled plans and added benefits, such as the AU Money Activity Plan Plus and other financial service packages that attract long-term users. Overall, KDDI's finance segment is growing consistently, with solid progress in both banking and credit card operations, helping to strengthen the company's financial ecosystem and support sustainable profit growth. KDDI's growth drivers for the second half aim to accelerate earnings through both its core services and new business areas. Mobile and IoT services remain the main pillars of growth, supported by steady demand and the positive impact of price revisions. Mobile revenues continue to expand due to strong corporate demand and stable customer relationships. At the same time, new product areas such as facility solutions, Starlink, and drone services are becoming increasingly important contributors. Sales of IoT-related services rose roughly 11% year-on-year, while facility solutions grew about 34%, and Starlink and drone businesses surged about 72%, reflecting strong momentum. KDDI is also expanding its connected car business, providing communication services for BMW's connected vehicles produced in North America starting in July 2025. Additionally, KDDI is leveraging its Takanawa headquarters as a model for digital office construction through KDDI Smart Space Design, sharing this expertise with around 80 visiting companies. Overall, KDDI's growth in the second half will be driven by a combination of steady performance in core mobile and IoT services and rapid expansion in new technology-based businesses, ensuring continued profit growth into the second half of the fiscal year. KDDI is also advancing data center expansion strategy, focusing on its main site in London to meet rapidly growing demand driven by AI utilization. The plan includes building a sixth facility in London at a total cost of approximately 60 billion yen, which will increase the site's power capacity by 1.6 times. The expansion leverages expertise from Telehouse, which is ranked first among telecom carriers for business connections and third globally, offering secure, urban-adjacent sites and an internet hub for 3,000 companies worldwide. The data center is optimized for real-time processing, including AI inference, with high-performance GPUs, water cooling systems to manage heat, and high connectivity for low-latency broadband communication. The project aims to achieve high margins per megawatt and optimize invested capital. The new facility is planned to open in FY2028. The next-generation infrastructure aims to quickly establish a secure, large-scale AI environment using Telehouse's expertise. At the Osaka Sakai Data Center, a sovereign AI platform will support both training and inference, enhancing Japan's industrial competitiveness. Gemini on Google Distributed Cloud and NVIDIA GB200 NVL72, starting operation in January 2026, will form the core of this nationwide distributed AI infrastructure. The value-added Real Technology Initiative collaborates with Lawson to create new experiences that connect with customers' future needs. It strengthens physical touchpoints by enhancing Lawson store functions to be closely tied to local communities. Trials include deploying AI-driven drones for remote customer service, enabling rapid on-site responses, and creating new customer interaction points. The employee-exclusive RealTech Lawson offers a specialized shopping experience in office environments, incorporating disaster prevention and crime prevention features. Stores operate efficiently with one clerk, dynamic pricing, and meal coupon trials, with data utilization aimed at improving daily sales and labor efficiency. Average dwell time is about 2 minutes, and approximately 80% of employees use the service more than 2 days a week, showing engagement with the new technology-driven initiatives. Additionally, KDDI has announced an interim dividend of 40 yen per share. The full-year dividend is expected to reach 80 yen per share, up 75 yen from 72.5 yen last year. Stock price. This chart over the past year shows the stock price in Japanese yen at 2,633.5 as of November 10. This shows the stock price in US dollars at 16.80 as of November 7. The stock price is about 6% higher today compared to before the earnings announcement. Current PBR is 2.02 and PER is 13.4. Dividend yield is 3.04%. Compared to the past few years, the current PBR and dividend yield suggest that the stock price is high. However, the PER is lower because earnings per share have increased more than the stock price. Although the stock price has already risen, it is a stable business, so it is still a good choice for long-term holding. Conclusion. KDDI achieved growth in both revenue and profit in the first half, remaining on track to meet its full-year targets. Strong performance in the mobile, finance, and DX businesses continues to drive earnings, supported by structural reforms and service enhancements. Looking ahead, KDDI plans to accelerate growth in the second half through AI-related infrastructure, data center expansion, and technology-driven initiatives, such as its collaboration with Lawson, ensuring sustained profit growth and long-term competitiveness.